Welcome to the Commercial Real Estate Investing Roundtable. While people are logging in, we go ahead and talk about a tech tool of the month. This time we're talking about two things. That way, before we get into very much depth, people have had a chance to log in and welcome you. I wanted to just tell you what was going on with ChatGPT 5, which was launched on August 7th and created a lot of havoc for a lot of people because they made it less friendly and more robotic. And it just really it threw a lot of people for a loop, especially because when they launched it, they did not give people the option to use the older versions. And people were screaming bloody murder about that ChatGPT was not working right. So they did go ahead and make it possible to go back and use the old versions. They're working on improving ChatGPT 5, and it technically should be more robust than the others, but so far it is not. All right. So the other tech tool that I wanted to share as people keep coming in, we had 140 people sign up for this. I'm really hoping most people show up this go around. I know a lot of people sign up and just want to get the recording, but the more the better, especially with the topic tonight. This is a great topic. While they're logging in, like I said, go over the tech tool. I just talked about ChatGPT. The other tech tool is something called Invisaware, and it's not just for women, but women most especially should think about it, especially if you're going into empty buildings or buildings where there's people you don't know and maybe you're alone, things like that. I have the necklace, but they also have bracelets and keychains where if something happens, say you fall through a floor, you get injured even too, if you're in one of those kind of buildings, then you can click twice on this and you can set up so it will call all of to 5 people. And it actually tells a central office to call them and they'll call and see if they know if you're okay and whatnot. The worst case, it will call 911. So it's wearable emergency type jewelry, basically. Even if it's a keychain, I guess you can call it jewelry. So anyway, those were the two tech tools I decided to talk about today. And then here, I just like to give a little teaser. Invest together to accomplish more. Scale into major real estate that offers major tax benefits, cash flow, diversification, leverage, and wealth building. That's what we're about. But in talking about these things, I like to help people know what tools they can use. And so with that, we will go through some things here. That was the tech tools, the agenda. Hopefully, everybody saw that when you registered. 7 to 7:10 is the tech tool, 7:10 to 7:20. We'll talk about market trends. 7:20 to 7:50 or so will be speaker presentation with questions and answers. And we try to end right on the hour. Respect your time. I'll also touch on this. We will talk about different things. And some of these meetings are potentially just roundtables to just talk and network. But because I'm holding this to an hour, I invite you to put your contact information into the chat, along with if there's any needs or wants you have, go ahead and put that in there because everybody can download a copy of the chat. And so that's another way people can be networking. So I encourage you to do that. I do, Madhavi, want you to go ahead and do that as well. Enrico, you can put our contact information in too. As far as deal expectations, as y'all know, this is about a tool this month, but we are able to talk about deals to some extent periodically. Although I need to tell you, we're going on a break until winter. So there's not going to be the monthly meetings right now, but this is intended to be a roundtable, and there are different ways you have to handle discussion. And so I do have an investment opportunity right now, which is a 506C. And that's the only reason I can talk about it is because it's a C. And it's the C's you can see advertised. It's the B's where you won't. If you know anything about syndications. Now, some of you probably do and some don't. If you go through my website or download the resource I'll share with you at the end, you'll understand the difference between B's and C's if you're mainly wanting to plug in for investments. But today, as I said, this is about a phenomenal tool that I want to share with people so that they can find ways that they can really put their money on steroids, is what I would say. Anyway, lastly, to get on our distribution list to find out about deals, you need to go to our website and sign up through the portal, or there is a QR code here where you can sign up that way. And who am I? I'm Ginny Bolling. I'm the founder and CEO of Pivotal Real Estate Investments, which is a private equity firm. Now, it's just a private company. And a lot of people get messed up with the word equity. Don't let that happen to you. So we specialize in syndications. We do joint ventures as well, but it's in commercial real estate. I am also a real estate broker and have been for over 30 years. Host a podcast called Pivot to Prosperity, where we talk more about commercial real estate. I'm a partner on 661 apartments, a 14,000 square foot medical office, and a 30,000 square foot office. And the value is roughly 103 million on those. We're adding some apartments here this month. I started in real estate in 1983, been in real estate, been in real estate then over 40 years and a broker over 30. I was an appraiser in the 1980s, so that kind of really baptized me in some crazy times. That was the savings and loan crisis going on then. So we were appraising whole subdivisions sometimes that were partially finished, maybe almost finished, and all kinds of different things in between. So been through some ups and downs. Most of my career, I've been in eminent domain though. So did land acquisition work with attorneys and appraisers, basically taking away property and then trying to fix it. Scary stuff, kind of. But so acquired over 600 properties in the past for road or utilities, telecom. One of my funner things to claim is that I was able to buy the last piece that was part of the missing link of I-95, if you ever knew about that. There used to be a place I-95 didn't connect all the way. I like pickleball, tennis, and riding horses. So that's me. And so I have been in real estate long enough and very excited about what is out there currently. And this correction we're in right now presents some really interesting things. So next, I'm jumping into a market overview. The commercial real estate market has been stressed for a few years now. Interest rates have gone up and stayed up longer than expected, and that has really put a lot of properties where the projections did not expect this into a stressful situation. Some are not cash flowing, some have been foreclosed. It's a really good time to be hunting for property in short. So if it will cash flow now, your chances are pretty good that you're in a good position because of the likelihood of rates going down. But even you got to plan that they're not, and they could go up. So you stress test both ways. But in any case, this is not only a good time to be looking at real estate because there's blood in the water, so to speak, blood in the streets, like Warren Buffett says. He recommends that's the time to buy. But also because we're in a huge generational wealth transfer. A lot of us baby boomers are retiring, so all the money from a business is either transferring to a new owner or it's being dissolved or liquidated, any of a number of things. So there's that transfer, but a lot of people are dying too. So there's that transfer of homesteads and all the rest. So it's a really good time to tune in and be aware of all the different options you have. So again, this tool that we're talking about tonight will empower you to have one more tool in your tool belt. I didn't really read that at all. You'll get this in this slideshow after we're done and along with the recording. So don't worry if you can't read all the slides. But it's worthy of note that, say on that last sentence there, that the industry is evolving. There's new methods and products and terms, all kinds of things out there. One of them being rescue capital. There's a lot more private money out there doing things than ever before. And Trump has signed some executive orders and some legislation, the big, beautiful bill that also enables the middle guy, the smaller investor, to participate in some of these bigger properties and ownerships. It will help you and your family, not only with tax deductions, but building wealth and cash flow. The national update I did last month, I'm including a couple slides because there was so much on legislation and there's so many more people that weren't here last month that signed up this month. I just thought it was worthy of keeping them in the deck here. Along with, I have a link to, I guess I'm getting ahead of myself. That's the next slide, that will give you a chance to hear an expert talk about all of that. But basically, the new legislation is very favorable to real estate people, practitioners. The 10-year treasury is at 4.2 and prime rate is at 7.5. Low risk loans in the commercial world are pretty much 5.1 to 6, excluding new construction. And again, always depending on location, the team, the experience, and all those other factors that go into it. But just as a benchmark, I tried to mention some of this. So the delinquencies I mentioned before are up to 7.23%. This is what these CMBS, the commercial backed loans, are something that were huge in the Great Recession in the residential world. We are going through the commercial version of that right now because the people that had floating rate debt most, especially, are the ones under stress now. So it's the commercial version of that. The stock market is breaking records, but a lot of people feel it's overpriced. But one more thing there, I think. The median home price in the US is $422,000 as of July, according to NAR, the National Association of Realtors. And the median rent, 1,700. And the national average as opposed to median at 2,000. And what that should mean to you, since a lot of what commercial real estate is about, at least in my world, is multifamily real estate. So when it costs that much to own a house, then people are driven to rent. They can't afford the payments because the interest rates are so high. So that's why I include that metric. I just want to be sure that I explain what that's all about. And so here's the repeat slide. I have it labeled as repeat up here in the top left, which gives you a breakdown of all the things. Now, this link here will take you to the recording with Dr. Boyd that goes over these things, and he did a great review of all that. This is another repeat slide about the Florida legislative changes, which was very helpful too, but I don't have time to go into those. I want to go ahead and introduce Madhavi, our speaker. Madhavi and I have known each other for a year and a half. Oh, no, it's actually probably closer to 3 years now. Madhavi?
Yes, absolutely.
Yeah. We've been in a couple masterminds together, and she created one that I'm a part of too. So anyway, long story short, she introduced me to a concept I had heard about probably 15 years ago. And I thought, wow, that sounds complicated. And I don't know, I just never thought I would use it. But then I've realized since then, the reason was that day I was introduced to this infinite banking at the same time as velocity banking, which are two different things. And so I want to make it perfectly clear to you, this is not a difficult thing to do. The difficult thing is to believe it's capable of what it's capable of doing. That is the hardest part to wrap your mind around. But in any case, so Madhavi is president of Think Outside the Stocks, the top 3% global podcast and leading wealth strategist specializing in infinite banking and risk managed real estate syndications. She coaches passive investors to grow, preserve, and pass on generational wealth through vetted opportunities in recession-resistant asset classes like multifamily, self-storage, industrial, and senior living. Co-founder of Connected Capital Fund, she built a collaborative network for capital raisers focused on due diligence and scaling together. With 16 years plus in IT before leaving corporate life, Madhavi's mission is simple. Change the financial trajectory of one family at a time and thousands more to go. Madhavi, welcome. I will stop showing my screen. Thank you for coming on.
Thank you so much, Ginny, for that introduction. I am happy to be here, excited. So thank you so much for inviting. And what a great group you have here. It's Monday, they have showed up. So thanks everyone for showing up on Monday this late. I know it's your family time. So a special thanks to you. And Ginny, I love your tech update, your market update. One tool that can change lives, one tool can save the life. And also, just there's so much blood in the market right now, and that quick commercial of real estate update that's helpful too. But we are here to talk about a tool that has been utilized in this country for generation after generation. And when we are starting to utilize it or know about it, right, it feels, oh, it's new, but it's not new. So mind you that it's not a new tool. It's been used by wealthy by for six, seven generations. So let's jump into that. Ginny, let me know if you can see my screen and I can go from there.
I see it.
Thank you so much. So, yeah, we're going to talk about multiplying your money, not your effort. Be the bank with infinite banking strategy. And this is infamously known as a Rockefeller strategy as well. So, I'm Madhavi Jain, again, President and Wealth Strategist at Think Outside the Stocks, also the co founder at Connected Capital. But we are here just to talk about infinite banking via Think Outside the Stocks. So, before I go ahead, though, just 2 cents from my lawyer that this is not your financial legal tax advice. This is not an investment opportunity. So if you want to utilize this, implement this, or anything else that's been talked about today, please seek your own legal tax financial advisor and seek out their professional counsel. Also, you will see I love two things. I love math, I love numbers, and I love history. So please remember that the scenarios that I create, a lot of scenarios, these are just point in time information education purpose only. In your situation, if you want to create a scenario, I'll be happy to do that. And I'll share some information about me, how you can reach out to me to do that. But this is just a point in time, depends on many factors, market fluctuations, etc. So please keep that in mind. With that, let's just jump in. So just with the probably show with the offhands, my first question always to a group, Ginny, is have you heard of implemented infinite banking? And if not, why not? So typically when I ask these questions, I used to have four answers here, but I have five now, right? So number one, that no, I have not heard about it. So that's why I'm not implemented it. Number two, yeah, I have heard about it, but I do not understand it. Number three, that I have heard that it works, but it takes time. And Ginny, you were talking about your experience and you were somewhere between that two or three bucket, right? Number four, that I don't have enough time. So I know it works, I know it's beneficial, but I don't have enough time to implement it. And number five, I've heard about it, but I think it's scam. So I would love you to use chat and select one, two, three, or four and just tell me where you are. And by the way, such a good mix of crowd here, some real estate agents, some transitional housing, and quite a bit of mix here. Please go on, please go on. Thank you so much for popping that up. So mostly one and two. Wow. Any five? Love that, Daniel. And we're gonna have some fun tonight. And I will tell you which bucket I was in. So please pop in your answers, and I'll tell you in a minute if I get three, four more answers, I will tell you what bucket I was in. Two.
I got to interrupt though too if anybody thinks it's a scam, because I'll tell you what, I over research everything.
You
So
do?
when it was reintroduced, I've listened to four books now on it and talked to probably 10 people that rave about what it's done for them personally, that I trust, that I know. I know it's not a scam.
Yeah, love it, Ginny. Thank you so much sharing. So we have mostly one or twos, and I have one five. Can you make a guess what bucket I was in? I was in five, guys. I was super skeptical and I'm super analytical, just like Ginny. And I'm super skeptical about it, and I was in that five bucket. I went back to my numbers. I am a math major, so my numbers are my trusty friends. I went back to my numbers, my spreadsheets, created a ton of scenarios and looked at different perspective, and I got convinced myself, and I realized that the scenarios, the numbers that I utilized and I created, probably that is what I can utilize to educate somebody. And that's essentially what my passion is. And you will see my passion coming through as well. By the way, Ginny, is the volume clear? Because I think I have two different microphones here. Is
Oh,
this better?
I hear
Is,
you okay. Can
is this
everybody
better?
else?
This is better, or both are the same?
Sounds the same to me, but
All right, perfect. So let's go ahead. So before we jump into it, let's try to understand the person behind, the heart behind Think Outside the Stocks. Who is Madhvi? Because before I do business with anybody, I just want to know what kind of person that is, what kind of ups and downs. Ginny was talking about the ups and downs that she has gone through. Why is she here and how is she here? That's really important. Ginny is built off a lot of passion, a lot of education, a lot of experience. So let's talk about what Madhvi is, right? So I'm a first generation immigrant. Now, what that means that I come to this country with two suitcases and 9,000 miles away from my birthplace. Never wanted to even leave my birth city. So that's a common story. I always say that we all have uncommonly common story. How many people have the same story that came to this country with two suitcases and built the life? So we built the life, me and my husband had a kid born here. We had purchased a house, but then 2008 happened. In 2008, the market and the job impact, it didn't just impact the job, but also impacted our house. So in that time, we had to move from California to Austin here, and we are here in Austin, Texas now. And we had to rebuild ourselves. Our savings were in, most of it is in stock market, and the real estate gave a good kick in the butt as well. So that's essentially how we rebuilt second time. And then I started working here again. I had a top five consulting job, both me and my husband, two kids. But in 2015, I had to exit my corporate job, six-figure earning job with one of the top five consulting companies. I worked for Deloitte Consulting in that time, just because of my health. And once I left my job, I started my financial freedom into the reverse order. There was a cliff that, okay, I don't have a job now. And I'm looking at my daughter and her education, and I'm like, oh my God, I need to have another job. Otherwise, I will not be able to support her education in any college that she wants to go to, and I'll have to compromise that. And I was not ready for that. So when I started my financial freedom in reverse order, I came across two strategies. One I was very excited about, which is commercial real estate syndication. Of course, started from being a landlord and doing the rental the traditional way, got impacted by, again, he kicked in a butt with that. And the second strategy, infinite banking, I was very excited, one I was super skeptical. Evaluated both of them, realized the power of them individually, and even more realized the power of them together. And that's once I realized that I was really happy that I can implement it from my family's financial strategy. But it made me restless, Jenny. It made me restless that people around me, they didn't know what these two strategies are. It's almost like a slave of a universe that they were living in, working hard, raising two kids in a corporate job or a medical field, coming from a different country as a first generation immigrant. So that's what made me restless. What makes me you restless is the problem that you're here to solve. And that's how I started Think Outside the Stocks. Again, Think Outside the Stocks as a fund manager. I saw another pain point that doing the due diligence and bringing the best in class operators and investments, that was not an easy job. So that's another problem that I was here to solve. And I solved that by forming a community of fund managers passionate about due diligence, just like me. And Ginny is such a proud member. We are so proud of her in this community. So I found that too in 2023, the connected capital community as well. So with that, my purpose, as Ginny already stated, that's my beautiful family, by the way. It's been a while. I think we are due for another family picture. This little guy here is now 17 years old. She is 22. And yeah, my dear husband. So I'm on a mission with that. I'm on a mission to change financial trajectory of one family at a time. And I'm talking about that 2-degree change, which can really make a huge impact. So that 2-degree change is going to start for many of you. I'm already sure that with Ginny and how you're connected with her, that impact has already started. But both me and Ginny, we are not only just connected by the same vision about our investments, but the mission about helping guys like you to change that financial trajectory one family at a time, right? Now, let's get deep into what we are here to discuss. I always like to step back a little bit and talk about the problem statement first before we start talking about solution. Ginny, with your permission, if that's okay, I'm going to jump into the problem statement. So, thank you. So, most of you are here thinking about a problem statement that number one, I'm exchanging my time with money. I want to retire. So, that's your one problem. Increasing tax liability, more I earn, more it goes to Uncle Sam's pocket, and fluctuating income as well as retirement passive income, that's the goal. So these are the problems that you're here mostly, and could be one or two additional problems. But what if I tell you that this is just scratching the surface? Yep. My favorite, by far favorite quote is by Bono. We thought we had the answers. We thought we had the answers, but it was the questions that we had wrong. What if we didn't ask the right questions and we don't get the right answers? So let's understand the blind spots by asking these right questions. Let's understand the blind spots that you didn't even know that you have. I'm known to ask the questions that are deep seated and start your thought process and trigger that. So let's talk about these blind spots. What if I tell you that your number one blind spot in your financial wealth is your family? Yes, your family. And again, I believe in two things, numbers and history. Let's look at the history, how I can firmly say that. So, learning for what I call financial fathers of this country, Vanderbilt, when he passed away, he had $200 million. That's $1.4 billion in today's net worth. As a net worth, the net worth that he actually really created from scratch. But where did this net worth go? His known heir, which is a media personality, we all know him, Anderson Cooper, from Paris Hilton, he inherited $1.5 million. Still a lot of money. But can you imagine from that billions of dollars, just 1.5 million inherited? Where did the rest of it go? Number two, tremendous respect for Andrew Carnegie. He is the one who focused on philanthropy, donated most of it to build schools, colleges, libraries, etc. He was philanthropy focused. $4.8 billion in today's net worth is what he passed, spread into philanthropy, no known millionaires. But Rockefellers, Ginny did mention about Rockefellers. What did Rockefeller's family do? They did something differently. They have about $460 million that he passed, $9.6 billion in today's net worth. 150 plus heirs, $11 billion known. There could be some other trust and entities that are not known, but that's known net worth. Multi-million of dollars continuous charity every single year. It's just not like Andrew Carnegie that the charity was done, it was spread, and it was gone. Multi-million dollars still going in charity. So we want to focus on what did Rockefeller family did that was different. Again, we're not going to focus on every strategy that they have. There is one very peculiar strategy that they have whenever there's every baby is born in the family. That's what they're using generation after generation in about six and seven generation. So let's again focus back on problem number two, that tax is your leakage. That tax is your biggest leakage. And thanks to our rich dad of the country, we have known the quadrant, the tax quadrant. And I don't want to focus too much on that, but we know that there's a simple employed business owners and investors who can actually get to that zero, so next to nothing tax liability. So when you are paying out of your pocket into your tax liability, you think that this is the only taxes that's the leakage. But
Hang
what if
on,
I
go back to that a second because
absolutely
you said that fast. Some people might not know that this is the four quadrants that Robert Kiyosaki introduced under Rich Dad, Poor Dad. And it really,
do
if
you
you're
want me
not
to
familiar
just
with it,
go
it's worth looking at because
yeah, I can literally quickly go over that. So the first quadrant where you have self-employed, you are a business owner, you pay your own taxes and the employer-employee taxes both sides, right? So that's the most bucket, 50 to 60% of the tax liability. The employee, these are the W-2 earners, probably medical professionals on W-2 as well, 30 to 40% tax bracket. And as you start moving towards the right-hand side, now you are a little bit different. You are a business owner. You are paying for your expenses first. These two quadrants, they're actually paying taxes first and expenses later. But on the business side, you pay your expenses first and taxes later. And that's how you are a little bit less than the right-hand side bucket, right? So the last quadrant, however, The real estate investors, the top 1% of this country, other investors, they use the tax rule book, they use the IRS rule book to get to that 0%. And trust me, I have seen somebody who has made $1 million in cash flow in a year and had $0 in taxes. So this is doable. So that's where you want to be. You want to be on the right hand side and most likely in that I bucket, the investor bucket, when you can create, whether it's cost depreciation or many bonus depreciation benefits or stacking up those tax benefits to get into that 0%, which is possible as an investor, right?
Or at least
So
close.
yeah, at least close, yes. I have gone to four figures. I haven't gone to 0%, but I have gone to four figures. So that has been an incredible milestone. But what if I tell you that when you lose that, you say that, okay, I paid 30,000 in taxes, 50,000 in taxes. That's not really the amount. Let's scratch the surface and look at if you had 50,000 extra income and if you had 0%, 15%, and 25% as tax liability, and that 50,000 just compounded at 7%. In 10 years, just that three different brackets, the difference is about 200K. So it's not just the taxes that you're losing, it's the taxes that the growth, the future growth that is compounded, that is what you are losing in an effect. So it's not just the money out of your pocket, but it's the ability of this money that's going, that's leaking, that can make that future money in your financial structure. So with that, let's look at our next blind spot. And I encourage you to take notes. I encourage you to pull out a pen and a paper. This is a lot of information is going to go through today. And if you want to list down any questions, list down numbers, anything to ask me after the webinar today or later on, please take your notes, be ready. Let's talk about, when we talked about tax savings, what is the number one tool that tax savings or the tax advisors will ask you to use is your deferred account, your qualified plan, your retirement plan, the 401ks. Now, deferred tax versus the tax free. Let's talk about that a little bit, right? If after retirement, if you have, say, $1 million in your retirement account, about a third of that money is to IRS, and then the rest of the money is for you. And let me explain that a little bit. Suppose you contributed to your retirement account for 25 years. On an average, say $20,000 a year. That's about 500K, half a million. And say if you say save the tax liability, that's about 37%, right? So 185,000 in tax savings. That's a tremendous amount of tax savings. But let's look at that tax deferred strategy, right? So with tax deferred, now if you grow that 500K in 25 years to a 3x minimum, right? 3x is possible in that 25 years. Now you have about $1.5 million. And even if you pay minimal taxes, right? The lowest tax bracket, 22%, even though the 330,000 tax liability is much higher, almost double than what you have saved. So you are not saving taxes, you're just deferring that more deeper impact to your taxes when you're actually taking out. But you might say that, hey, I'm not going to probably take out everything, I'm going to pass it to the heirs. But let's talk about first your retirement, that when I retire, I'm going to utilize that. And we are assuming that 22% is going to be your tax bracket. Again, let's go back and look at our history on what historically tax bracket has been. Defining your future liability in terms of taxes is very tricky. These are the marginal tax rate for highest and the lowest wage earners that had moved in our country. And as you can see, the map is all over. Of course, I have considered it from 1990s, like quite a bit, quite a many years ago. But even you can see in like 80s, the top tax bracket was 70. So it has dipped a little, stabilized a little, and it has been stabilized a little bit more. But can you imagine what your tax liability is going to be when you retire? That's a big question mark. So when you're relying on saving taxes on your current tax bracket, you don't even know what that future is going to be have planned for you. But now you're not going to utilize all this money, and you may say that, hey, that's not going to be my tax liability. That is going to be your kids' tax liability. So when you pass this wealth to your heirs, and if it is your spouse, They have 10 years to take out of it, but if you have your kids, they have 5 years to take out of that with the Secure Act. So imagine for your kids, when they are earning probably top dollar 200K, 300K, and they are in top tax bracket. And if you leave $1 million to them and they have to take 200K out in a year, can you imagine how much tax burden they're going to have? They're going to be doing it from their top tax bracket. All right.
Do you
Let's
mind
talk
going back
about,
and show that again a second?
yep.
I found it astounding as I read these books as to how high the taxes were way back when. It is flabbergasting.
Look at that. Look at
And
that.
given, and all the same sources show the same thing. Given the stimulus and all after COVID and all that, we know inflation's being held in check right now. But look at our debt. Our debt is just so there's going to be more and more ways the government has to tax us to be able to stay and hopefully stay in a position where the dollar is the number one currency. But it is truly flabbergasting to see how high the taxes were.
Absolutely,
Go ahead.
Ginny. So I'm going to move to our blind spot number 5, and thanks, Ginny, for adding that. Even with the estate tax, let's talk about estate tax exemption, right? How many here think that I never have to worry about estate tax because now it's already at about 13 million something, and with one big beautiful bill is about 15 million per person. That's 30 million I can pass income tax free, and I don't have to worry about that because probably I will never reach that level. So just in the chat window, if you think that I don't, yes, if you think that estate tax is going to be a problem, and no, if you think that it's not going to be a problem. So just fire that up, and I'm gonna bring it up here that the estate tax exemption limit that currently is that we don't think that is going to be applicable. Again, let's go back and look at that history of the exemptions, right? So 2001, 675K. Everything else was 55% plus. We have moved to 5 million, 2 million with Trump administration coming in first time, it went up. It was supposed to sunset 2026. Now we are at a 15 million again. But do you know, even if says it's permanent, your future Congress and administration can. Ginny, I think somebody is unmuted. Can you check who is that and mute them, please? Let me know when you're done with that. All right, so with the political shift, the future Congress and administration can pass a legislation, can change this, just like how it has changed to 15 million and bring back down. So it all depends on the climate, the political climate. The second thing impact is the budgetary consideration can also force this to change because with one big beautiful bill, the 10-year Fed tax decreased revenue is about 212 billion. Can we sustain that with the trillions of dollars of debt that we have? Do you know where does the future stand? Can you define or can you even imagine when you die, what is that tax liability is going to be? So can you, I know you can time your time for retirement, but can you time your death and what bracket you are going to be in this? By the way, the best time to die was 2010 because that year it was repealed for the modified carryover basis to adjust that. We didn't die then, so unfortunately, we don't know where we are going. All right. So what are we here talking about today? We are talking about how do you earn, save, and invest. And we are going to focus on invest the same portion of it today, right? So you earn W-2, rental income, cash flow syndication, probably a business. You save, probably put some money for debt management, retirement accounts, emergency funds, probably high yield savings, stock portfolio for investing, diversified real estate. These are the two buckets, the emergency funds and high yield CDs are our bonds or treasury bonds, etc. That is our focus of our conversation today. Let me be very clear. We are not talking about creating your investment vehicle or diversification in any other asset classes. We are talking strictly about your savings, which is your emergency funds, your high yield CDs, treasuries, bonds, etc. Right? So again, let's ask two questions. The right question, as Bono said, about your savings account, and let's challenge how do you think about savings? Who here is really happy about your savings account today? Because the money market account is really giving you really good percentage, right? So let's talk about that. Let's talk about that and interest first of all. It is fluctuating. You probably got 5.5%. It is down to about 4.5. But a couple of years ago, this fluctuated less than 1%. Around COVID time, when the interest rates were really low, that was about less than 1%. We didn't even get that 1%. On top of it, we have a tax liability. So even if you got 5%, and if you have that tax liability, which is coming at the end of the year, so you don't realize it now, but reduced to that about 27%, 24%, or 30%, the effective rate of that 5% could be about 3 to 3.5%, right? But think about inflation. Inflation is about 3 to 3.5%. So this, if you are getting that as an effective rate with inflation, you are zero or net negative. That's huge, right? So it is really a question that also the FDIC insured institutions that you're keeping this money in, are they stable or that they are volatile? What happens when recession hits? When in 2008, even we got to see SVB in this timeline near COVID, when these banks go belly up and they needs to be rescued, right? So what is that stability of the institution that you're keeping, even if it's FDIC insured? So when you are saving into the bank accounts, the question that you need to ask is your savings serving you? Or is it really getting stagnant, or even worse, it's diminishing, it's eroding your money, right? So let's talk about the summary of all the problems that we have talked about, from generational wealth depletion, from tax leakages, low interest and tax growth, insecure and volatile banks, the estate tax problem that's you're going to be a future problem. And also, when you have these bank accounts, there is no or the expensive asset protection. If somebody comes and sues you tomorrow and you have this savings account, it's going to be an exposed account that the lawyer would be ready to take that money away. But on top of it, let me ask you one question. So just because you have 100K, 200K, say, sitting in your bank account, does your bank come and say that, hey, dear customer, because you have 100K, 200K sitting in there for 2 years, 3 years, let me provide you some additional benefit if something happens to you? And that is a question that is actually a bonus question that gets answered by infinite banking approach. So let's talk about stepping back. I like to think about financial structure, not from a frog sport perspective in a pond, because a lot of people come to me and ask me, when is your next investment coming? What type of returns? When can I be financially free? But I like to look at from an eagle side perspective. Changing a perspective changes our outlook, because now we can see more problems as an eagle eyes perspective in a forest, and we see different kind of solutions to that problem too. So change your perspective and think beyond just a passive income and financial freedom, but think about growing, preserving, protecting, and passing your generational wealth. And my friend, today I'm going to challenge to do that exactly. So I look at the financial structure in a Maslow's pyramid. The bottom of this pyramid is your risk-free foundation. And Ginny, we are in real estate world, we are in investing world. We know that we cannot use something called guaranteed or risk-free. But this is the foundation that is what we're going to talk about today, which is risk-free and guaranteed growth. So the bottom layer is foundation. It's just like your house foundation. When you say that, hey, house burned down to the foundation, that means you can rebuild the house from the foundation up. As you start going up, now your risk goes up and your control goes down. So it could be investing yourself or your business. It could be a direct real estate investment, your rentals that you can control, your indirect investments as you go up, maybe your syndications, etc. And on top stays the speculative investments, whether it's your crypto or whether your volatile stock market. I often see this pyramid upside down. Take a picture of this. I highly encourage that, and put a number, no, put a percentage of your wealth that you are amassing right now, and see where your percentage is. How much do you have for that emergency money and protection for yourself? And as you build this up, now I call the four pillars, which is life protection, tax planning, asset protection, and estate planning. So this is essentially what the top 1% use as their financial blueprint, and really to get that group protect, preserve, and pass their generational wealth using the estate planning, insurance strategies, etc. So take a picture, get us, few seconds, take a picture of this and ask that question. And if you haven't started building it, this is something that can, if one thing you can take away from it is this pyramid and how you can build your financial structure. So let's talk about the tier one. That's the foundation, creating your own bank. That's what we are here to talk about. So now imagine a saving strategy. We talked about the saving strategy problems. We talked about the fluctuating interest. We talked about the tax fluctuation, the tax leakage from top of that. We talked about the institutions which are not stable and also inflation eating it, right? So now imagine a black box. Before even we go into nitty-gritty details of infinite banking, the black box that can give you guaranteed growth, number one, much better than banks, that's historically proven. Number two, you can grow this tax-free, just like Roth, and withdraw it using leverage strategy, tax-free as well. Number three, you can create your own limit. This is not your like 401k or 529 plan. If you want to put 20,000 into it, you can put 20,000. If you want to put 200k in it a year, you can do that. You can contribute without limit. You can create your own limit for this. It is liquid, just like your banks, to use for any purpose at any age. You want to use it for retirement when you're 55, you can use it. You can use it for your kids' college education, you can use it. It's not marked for education. So if you don't utilize it and you want to utilize it for your vacation home, if they didn't utilize it, without any penalties, 529 plan applies. You can utilize it for anything else. So no restriction on when you can withdraw. There is no credit checks. There is nothing. This is your money, completely liquid. It provides you automatic asset protection. This is hidden from the creditors in most states. In fact, when you complete the FAFSA form for your kids' education, it is not even shown up there. In fact, if you want to have accreditation letter, it shows as your net worth. So this is very interesting. So it shows when you want to show it. It doesn't show when you don't want to show it, right? And that provides you asset protection in most states. It provides income tax free, unlike your 401k. It grows inside tax free. And this is the income tax free generational wealth that you can pass to your next generation. And on top of it, in 150 years plus, this has never lost money, even during Great Depression, even during 2008. And we have history, we have numbers to prove it. I'm not just saying it. So imagine that black box, and that black box on baseline, bottom line, it protects you, which is you are your biggest asset. So that's the infinite banking that we're going to talk about today. So behind the curtain, now be very interested that what is this black box? I'm going to unveil that curtain for you. So behind the curtain, infinite banking is, and please note down, write down every word that I say, because this is not the ordinary structure that you're used to seeing. Infinite banking is very important. It's a strategically structured. It has to be created very strategically at the beginning. Whole life product with mutual company. This is a dividend paying whole life product. This is not your IUL. This is not with your stock market. These are the companies who are existing 150, 170 years also. This is how it works. As a default, a whole life product dividend paying generates a cash value. That is its characteristic. We take that characteristic, we exploit that, which provides the dividend year. We overfund this so that the dividend, instead of then getting that cash value generated as a small amount every year, we overfund it and we get dividend on every dollar that you're going to move from your bank account to this structure. And now you can actually live your life insurance. Life insurance is about life. It is tied to the death benefit for a long time, but now you can use it as its cash value to invest into real estate, to fund your kids' college education, to draw retirement income from it, or to buy your vacation home or anything else. So you can have any purpose, any age, easy access. And on top of it, remember I was talking about, does the bank give you any additional benefit just because you're keeping that 100, 200k in there? This one, it protects your life, permanent life protection. No matter, it's not like your term, no matter when you die, whether it's 10, 20, 30 years, even if you die at 99 years, it protects your life and it gives back that money to your heirs. But wait a minute, we have quite frequently heard buy term, invest rest. So let's challenge that. Again, I'm gonna reiterate this, change your perspective from passive income and financial freedom to grow, preserve, protect, and pass your generational wealth. And let's challenge with that changed perspective. Why do we not just buy term and invest in rest? So let's compare it. Most of you are here savvy real estate investors. So let's compare with the rent because we understand buying versus renting very well. As a rent tenant, if you just don't buy a home for 30 years, 20K in rent, 600K out of pocket, we all know it's zero equity. That all of it is out of pocket. If you buy your first home, 400K, you have much more amount, 700K plus out of pocket. But this is also appreciated. And after 30 years, you're going to have almost $1 million free and clear, including that equity. Your luxury home, however, $1 million home, you will have much more, almost double, $1.8 million out of pocket for 30 years. But why would you do that? Because even with that 3% appreciation, and out of pocket that you have paid, 30 years later, this is going to be free and clear your home. $2.4 million in equity is what you're going to be sitting on. Now let's compare that with the term. The terms are cheaper, no doubt about it, but this is going to drop off. By the way, the insurance company, the amount of time that they pay out the term is about 2 to 3%. So even if you have, say, $2,000 out for 30 years, 60K out of pocket, there is a $0 cash value, very well compared to the equity of it, right? An ordinary life insurance, if you say six to $7,000, about 24 years, about 150K out of pocket, much more than that 60K out of pocket, but it builds a modest cash value, about 200K plus cash value. But infinite banking is this whole life product on steroids. If you, instead of putting in $6,000 to $7,000, if you put 20K, by the way, this is not the cost. This is a portion goes to cash value, sits there, earns that dividend. And if you fund it for 24 years, about $500,000 out of pocket, why would you do that? Because now you have $1.2 million plus in cash value. This is what the capacity of this snowball that you are going to build till the day you die. And that's why you would do it, right? So now, wait a minute, let's talk about taxes and insurance on that $2.4 million equity. I just gave these numbers to ChatGPT that if there is an appreciation of the $1 million home, how much tax and insurance can I combinedly? It gave me a larger number, but I just put conservatively here 1.5 to 2.5 million, depending on what state you are in. You don't pay anything additional in the infinite banking, but you get something additional. When you have the whole life product, when you add this, you have about $1 million permanent death benefit that never goes away. You don't have a permanent death benefit sitting here. You don't have a permanent equity sitting in here. And when you actually move towards the right, when your cash value is growing in infinite banking, your death benefit is multiplying, growing, compounding as well. About 2 million plus is what the death benefit that you're going to have when you have been building 1 million plus cash value in here. In addition to that, why would you buy a life insurance that's permanent? Now, let me ask you, changing the perspective again means a lot to me. A 40-year-old, when he retires at 65 years, with 150K income, 3% modest income growth, and savings 100K, growing in 6%. Take a snapshot, take a picture of this slide if you want to understand that. Again, I play with a lot with numbers. So this person in his lifetime with this modest income growing at 3% growth and a 6% that he can put it into the savings bucket, the potential of income that this person can bring in till the time that he retires is about $5 million. That's a whooping strong number. And with that 100K growth, with that 6%, that wealth potential is about $10 million. So this is, you are building in your lifetime this income. You are the goose that lays the golden egg. You need to be protected. That should be your top priority. And your protection should not go away in 20 years, in 30 years. If you talk about insurance, let me ask you, what can you go and cancel now? You have a home insurance, you have a car insurance. Can you say that, hey, my home will be completely paid off in 30 years? I do not need an insurance. In fact, you would need insurance for sure after that 30 years. So can you go ahead and cancel that home insurance after 30 years or even the car insurance after 30 years? Then, my friend, why are you thinking about canceling your biggest asset that needs to be protected permanently and keep these assets which you can create that again and again. You are the goose. Don't just protect the golden eggs, you protect your goose permanently. And that's why, you need to think about the infinite banking structure. So this is in a quick visual. I know we don't have too much time, but I'm just going to pass through this. This is in your lifetime, you want to push things in the savings bucket, in the investment bucket. You have some kind of evaporation happening in here, but this is the tight lid is what is needed in your savings whether it comes to your emergency, your sleep money that I call it, needs a tight bucket. Never ever should go wipe away or should evaporate. And think about what your banks are doing. And what we are talking about when you have your lifetime savings coming in, this is the safety bucket which builds the cash value life insurance, and on top of it sits your death benefit almost at the negligible cost when we build the right structure with infinite banking. So now let's reimagine that saving strategy, which is again, like I said, guaranteed growth better than banks, tax-free growth and tax-free withdrawals using leverage, contribute without any limit, liquid to use for any purpose, any age, automatic asset protection in most states, income tax free generational wealth, 150 years, even during Great Depression, has never lost money, protects you, that is your biggest asset, provides you permanent death benefit. And but what if I tell you that there is one more benefit, one more powerful strategy that you can utilize this infinite banking structure, and that is you utilize it as an and asset. You can grow at your dollars, you can grow and invest at two different places. So while this money is growing inside your infinite banking, suppose you have an investment opportunity, a syndication opportunity with Ginny, and you have 50,000 in your savings account, that savings account comes out, becomes zero, and you put that 50,000 into investing account, and that investment grows. But in this case, that 50,000 never comes out. You will pay a simple interest on utilizing that structure. But now this is compounding till the day you die, and it also can be invested at the same time. So this is an and asset. And the visual that I was just looking at some time back, this savings account, when you have emergency savings, your business reserves, and now you have that 50K say opportunity reserves. And typically when you buy a rental real estate, take a loan from the bank and took a 20% down payment from your savings account. Instead of that, you're going to take a leverage even on that 25% down payment. So everything becomes your leverage. And this money, since it never comes out, it still earns that compounded growth. This is why you would borrow and not withdraw and have continuous growth for your money as you're investing as well. So that's essentially what infinite banking is. It is providing you, traditionally it was just about life insurance, but now it can protect you, your biggest asset, and also provide the safety, liquidity, higher rate of return, and also the tax advantages. I like to address it's not just the grass is not just a green, but there is a catch. There is, since this is a insurance vehicle, your medical qualifications do apply. Being healthy is a big plus, but if you're not healthy, if you have terminal conditions, if you're not insurable, we can utilize this for your family. Your spouse can have it, your kids can have it. It does have time capitalization factors for break even. You have to put money to use it. It's not a get rich overnight scheme, but the money that put in there and what cash value you have first year, you can utilize that within 30 days. There is government limit. I have to be careful when structuring this. So that has to be applied. And I cannot insist enough that this is your properly structured whole life product with mutual companies. This is not IUL. This is not your just any general life insurance, probably the life insurance that you're holding right now. So with that, it also provides some additional benefits, which is the death benefit, of course, we talked about. You can add at some small cost a disability waiver. For most companies, the chronic illness rider and accelerated death benefit, if you have just 12 months to live, if you have a terminal conditions, these are most companies offer free at no cost to the insured person. Chronic illness, essentially, if you 2 out of 6 daily living activities, if you are not able to do permanently, it can provide you that kind. It's not a long-term benefit, but it can provide you something similar. So once you create it, how you utilize it, you can utilize to grow your savings. If you never want to touch it, that's fine. You can utilize it for investment. You can utilize for education, unlike 529. This does not have impact on FAFSA. You can utilize it for retire. You can also use it for contingencies, vacations. Volatility buffer is actually a strategy that you can utilize with tax, with the stock market when you retire. It provides the hedge against your stock market as well. So really using the same dollar, whether it's your expenses or your investments, you can click on replenishing it and use that same dollar at two different. To sum it up, never lost any money, 150 plus years, tax-free growth and distributions using leverage, guaranteed returns, and it also has proven dividends. If we have time, I would love to show that dividend chart to you. Easy access to your emergency funds, no credit check, no approvals needed, no limitations on contributions or access, and any amount, any age, you can really contribute to that. Pass on a tax-free, income tax-free wealth to the next generation, and automatic asset protection. So with that, I'm gonna just quickly put it up here that what are the next steps? You meet with me, we create a structure together, and education is really the key, right? For me, education first. No, so many people don't understand that. Simplicity is my superpower. I love to simplify, educate you. Understand your goals and objectives. I'm an independent broker. I can work with many companies. So based on your goals and objectives is what I'm gonna help you structure it and build that guaranteed growth foundation. And with that, once we create the structure, tweak it the way you want it, you max fund it, you receive your guaranteed dollars and dividend, and without disturbing it, you grow it, access for any reason, fund it, and repeat it. So that's where we land here. Infinite underscore call at the bit.ly link. That's where you can structure a strategy session with me, or you can point to that QR code there. This is where we can get together, talk about your goals and how you can implement it, and take it from there so that we can create your own structure, your own module for this one. So with that, Jenny, I'm going to open it up for questions.
So before we do that, let me see if I can't make it resonate a little bit more the way it did for me, maybe.
Sure.
Is it okay if I show the policy quote that you put together for me and just talk a little about that? Is that allowed?
Yeah, I typically, because it's personal to the clients, I
I'm
don't
okay. I'm
share
okay.
it.
I just want
But
the,
if you want to share it, feel free to do that.
yeah, I think it will really resonate if I can show people, and you have to correct me if I'm saying it wrong, but let me share my screen a moment just to try to hit this home. I think it will make a difference to really show the power of what I'm trying to get across a little more, because you do get into the details a lot. And
Yeah.
if people don't really see, I know right where I want to put the money. Some people don't know that. And so this might make it resonate a little more. Can you see my screen?
Yep.
Okay. So I have a 1031 that did not work out. So I have a lump sum of money and I'm 66 years old. So I'm not the ideal age to be buying insurance, right? But I realized late here the power of this thing. And I was like, Madhavi, tell me what I can do so that I can use this to leverage into these policies that give you so much flexibility because you can borrow against your death benefit, basically, or what you put into it. And while it's compounding over here, you're investing over here, maybe in a syndication, maybe into a whatever it is you want to invest in over here and here, maybe too. Maybe you're financing one of your kids' cars or college. That you can look at my net cash value here. So let's just look at the columns. The contract premium, okay, and this is what I would be paying, all right. And then it goes down to 8,000, and then it gets to where it's zero. Of course, for me, I won't be living. I hope I'm living into my 90s, but anyway, so it gets to where it's paying for you. But in any case, I just want you to look at these first few lines here. So you've got a net cash value. This is under the guaranteed column too, right?
Yep.
Here's my death benefit. Are y'all with me? Is this gonna help? Hopefully, I didn't ask you to all turn on your. Anyway, I'm gonna keep going. here's the contract premium. It's starting at this amount and then it's going down to likewise to match here, the contract premium. And over here, they're showing you what the typical dividend would be. All right. This is based on historical numbers, and then the net cash value based on that. And then it goes over here. So the bottom line is they don't worry about you if you structure this right. And it's can't say that enough. You can be, you're borrowing against your cash value. And so it keeps growing over here as if you never borrowed against it. And you can go use it over here and make 12, 14, maybe more percent. Most of our syndications are north of 15%. And while you're over here, you're on an average of 3 to 5%. No matter what, it's going to keep growing. Whoops, well, the dividend's going to add to it, but it's going to keep growing. And if you die, what happens? Ideally, you're paying back these loans and you get disciplined. If you're loaning your kid, you're using this as the bank for your kid to buy a car. They pay it back. They learn that discipline because it just makes us grow more. And then if something happens and you die, they just deduct it off the payout at the end. It's not a big deal. It's just all this potential money that you can use in multiple places is my aha. Does that help? Go ahead and ask
Yeah,
questions. You can
definitely.
come off of the
Yeah, definitely, Ginny. And if you allow me, I can show them a little bit different example because in your case, you know that your death benefit was not something that you wanted to focus on later years. So we
yeah, I
struck
wanted to focus on the cash
really,
value. I want to be
yes.
able to
So
use
we
that cash value.
yeah, so we really focused on what you want. And this is why I say that every person is different. And
Yeah,
that education and aligning to your goals is really important. We got
yeah,
almost 90% plus cash value for Ginny in the first year itself. But that's essentially what her scenario is, right? For your scenario, it could be different. Ginny, if you want, I can share my
yeah,
screen and show that example where it compares the whole life. But of course, I want to be respectful about you guys' time too. Are you
yeah.
okay if we jump into that example? Is that okay?
If people need to leave, go ahead and leave. We will have the recording, but I think it's important to try to
Yeah,
wrap this
yeah.
up and let you guys
So let me
ask questions
just,
if you want. I'll check the chat too. Maybe
yeah.
they
So
have been.
actually, let me just go down here. Yeah, so I have, by the way, this policy, Ginny, and just you, I put examples in here based on my family's for policy or structure too. Can you see my screen here?
It's too small for me.
Okay, so let me just present from the current slide. All right, how about now?
That's, yeah, good.
Yeah, so this is a policy, this is a whole life and a really good structured whole life. This is not infinite banking, very well structured whole life on my family's member. So as you can see, 7,000 got $1 million death benefit. And now 7,000 first year has zero cash value. This is how a whole life works, by the way. Slowly it starts creating that cash value in year 2, year 3. Sometimes it doesn't create by 3 or 4, right? So now let's look at that. By year 6, I would have paid 53,000 in it. And this is the cash value, right? And as we go on, year 15, I would have paid 106K into it, but it still hasn't, what I call a break-even point, hasn't reached the break-even point, right? And this was supposed to reach break-even point in 16, 17 years. So now let's consider the same thing for infinite banking. 20K per contribution instead of that 6, 7,000 a year, 24 years contributed. And how does that look like? So now look at this, 20,000 contributed, very easy to understand. Starting benefit is about that $1 million, but look at this, the first year itself, both in the guaranteed portion and non-guaranteed portion, there's a cash value sitting in here. So this is that extra cash value, extra cash that you put it in here, that 7,000. You can consider that as a cost, but the effort is how can we make that cost negligible very quickly, right? The previous policy you saw about 16, 17 years is a break even. Now here, 20K contributed about In 6 years, about 120K. In the non-guaranteed portion, this is break even in 6 years. So that is my effort, that about 6 to 8 years, typically based on your age or what way, how you're funding it. That's what the goal is, that about 6 to 8 years that we can break even. What that break even means is that whatever money that you have put in here is available for you to borrow from it, and or even you can take cash, but then it will just fall apart. But you can borrow from it and put it anywhere else. But that 120K that's sitting here, it still has 1.1 million permanent debt benefit. At this point, this is better than your term, because in your term, you could have probably 2,000 every year, could have done 12,000 down the drain, not gonna create a cash value, $0 in cash value. But here, the break even has happened, and that $1.1 million is sitting on as a top. But let's take a look at this for a second here. This is every year how it's changing, the cash value is changing. In year three itself, when you contributed 20,000, you are net positive by $700. So that means though it took 6 years to break even, it started being net positive in third year itself. And as you go down in year 15 or so, 20,000 went in as a premium, but 20, 44,000. So reduce that 20,000 from it. So 24,000 is a growth in one single year, which started at $700 is 24,000 in a single year growth. That's the power of this compounding, right? So now let's take the step further. This 500K also contributed. If it let it grow for 30 years, the cash value is $1.2 million. But think about where the death benefit is. The death benefit is $2 million. The first example I showed you with $6,000, $7,000 premium, 1 million is a death benefit that stayed permanent even if you died at 99 age. If you die 30 years later, 40 years later, what is that inflation going to do, that death benefit? 1 million today and 1 million 30 years later is completely different story. Here, it's not only compounding the cash value, but it's compounding the death benefit too. So that's essentially the power of this infinite banking is. Does that make sense?
Talk on how long it expects you to live.
Yeah, I think when it's typically, I don't have that one in the example here, but typically by 80, 85 age, if that's what, expected age is, this is going to compound till the day you die, both in terms of cash value and death benefit. And let me actually go back. By the way, I'm gonna.
Mine goes much longer. I thought it went to 2000, or wait, doesn't it go to, assuming you make it to 125 years old? That's the maximum that anybody's expected to live right now.
Yeah, it shows the tables. I would not think about it beyond 100 years, but it can show the tables, which will go a little bit further as well.
Okay. Anyway, anybody have questions? My main thing is to be able to borrow against it right away. So I'm loading mine heavy in the front end, but that if you're not as old as I am and you can do it normally, you
Yeah.
can do it for much better
Yeah, you
rate.
can borrow within the first year cash value. Within 30 days, you can borrow, depending on the
Yeah.
companies, you can borrow about 80 to 90% of that cash value. By the way,
Yeah, so I
Patrick
have an
has a
investment right
question.
away. I'm
Yeah.
looking to start this and invest right away within a couple months. So it's not like I have to wait until that break even point she was talking about.
By the way, Patrick has a question that I was always taught that this is set up with an IUL. I do infinite banking for two reasons. One, number one, to educate people about it, how to utilize it, and number two, that to show them why this is not an IUL. By the way, infinite banking was not a concept. Nelson Nash is the pioneer of it. He's the father of this concept. And repeatedly, he insists that this is not an IUL. In fact, they don't even permit using IUL for this setup. IUL, when I showed you the guaranteed and non-guaranteed portion, the guaranteed portion of IUL, if you look up the model and look at it, one fine day after many years, when I were around 75, 85 years, this goes down to $0 in cash value and $0 in death benefit. We do not, that's not guaranteed. Remember, we're talking about the foundation, which is the guaranteed growth. And that's what we want to build on. IUL is not guaranteed, it's based on Certain indexes in the stock market, this is taking the risk and putting it back in your pocket. So definitely this is not an IUL.
So we had a question about how much do you borrow for? What's the cost?
So depending on insurance companies to companies, current cost for some companies about 5.3%, 5.8%, but I would say that pay that as a simple interest. Let it grow inside as a compounded growth. And if you allow me again, I'm going to show you why you would keep on paying as a simple interest and why would you borrow it. So let me share my screen here again. That's a great question, by the way. All right, so let me show this to you, okay? Understanding the power of compounding, right? Let's just think about, people quite often ask that why should I borrow using my own policy? Why should I not pay by for myself? And that's the typical 401k loan, right? You pay yourself. In typical 401k, if you have 400k into your 401k and you borrow, you take a loan of 100k, the 401k becomes 300k. But here, if it is a 400k and you borrow from somebody else, just like your home equity loan, this stays 400k and you take that 100k, put it into investment. So if you have, say, 200k, you can see my screen, right, Jenny?
Yes.
Yeah. So
Yeah.
yeah. So if you borrow 200k with a 7% interest over the period of 25 years, you will end up paying about 224,000 plus interest just by being in this mechanism. Now you would say, Madhavi, that's crazy. Why would I pay 200k plus interest to somebody else? My friend, because of the compounding. So if you save 2% less, whole 2%, I'm not even talking about half a percent or 1%, whole 2% less inside this strategy, that 200k for $25 and no more deposits, this has a capability of bringing you more than double this interest that you will pay. And that's the power of compounding, because every year your interest is tax free and it's adding to your principal. And that's the compounding. Compounding interest is the eighth wonder, as Einstein says. The one who understands it earns it, one who doesn't pay for it. So you want to see what side of this vehicle that you want to be. And this is why you would borrow and not just take a cash out of it. Daniel says this was a lot of information and still confusing. Hope to watch it again. Yes, please do watch it. But also at the same time, do consider to just jump on a call with me just to understand this more. Just because your scenario is going to be completely different, your models, I would be happy to build that for you and show it to you and educate you on how it can actually make a difference for yourself. So again, few of the things that I want to reiterate here. People quite often ask me that, hey, this is confusing. I don't know. I'm not gonna implement. I'm gonna think about it. But I want to history again, tap the history, and look at who historically has utilized this. John D. Rockefeller, we talked about that. When Walt Disney had a dream to build the most happiest place in the world, who did not trust on the theme park theme that he had is the banks. So he went back to his policy his whole life and he borrowed from it. JC Penney could have collapsed, not existed in 1929 stock market crash, because he didn't have money to pay even his payroll and he borrowed, he used his cash value to pay payroll. John McCain used to fund his campaign. But what was most shocking and surprising for me is that the majority banks, they are using this strategy, something called BOLI, and majority of corporates, they're using COLI too, like Walmart and stuff, right? So why are they using it? That banks with 500 million plus in asset, JP Morgan, 10 billion plus asset. And this is, by the way, public record. You can go into FDIC call reports, SEC filings of each bank, and you can see these numbers. Bank of America, 8 billion plus they have in BOLI. Just look for BOLI on this reports. Wells Fargo about 18 billion plus. And the reason that they're using it, because this is considered as asset. This strengthens their balance sheet. This is their capital preservation strategy. And this improves their ROA as well as this is the tier one asset. That is how it is considered it. Over 75% Fortune 500 company, including Walmart, P&G, they're using something called COLI for their corporate employees as well. So it's really the time to ask the right question. If it is good enough for the banks, large corporations, and billionaires, then why is it not good enough for us, for you? So that's where we are. And I know many of you are here and you find this concept intriguing, and some are committed to their wealth preservation and they want to take an action. They want to go back and say that, yes, I want to take an action. But there are some people who are going to be defiantly committed and they're like, no matter what, I want to make a change and that change to happen, right? What's going to happen is that right now it's 100% important to you. Tomorrow, this is going to be 50% less important. And within a week, that importance is just going to go away. So, really, the time to take action is right now, not tomorrow, not today, but right now, because tomorrow, the thing that this depend on is age and health. At least one thing of your age or health is going to change tomorrow. So at least, jump on a call. If you don't want that whole hour of call, jump on a call for 15 minutes. Learn the logistics behind it, what this is, what can it do. Get that model in your particular scenario. I'll be happy to show that to you. And then decide after that call, after that one or two calls, after I create that design for you, whether it's for you or not. Because if you let this go right now and tomorrow your age and your health is going to change. And I have many clients who essentially sat on this, had the model ready to go, didn't sign it, and had a stroke, had something that changed their health, and they just couldn't be insurable anymore. And the classic irony is the biggest example is me. I am very passionately implementing this for many people. I'm helping Ginny also to implement it. It hasn't gone through, but I'm helping her to implement it. But unfortunately, I am disqualified to have this on my life. Before it's too late, at least tap into it and see what it can do for you. And with that, I will take more questions, but I will be happy to continue or stop here as well.
We have another question here that I think is especially good too, but let me mention though, based on what you were saying, you can take an insurance policy out on a family member. That's what the Rockefellers do. As soon as everybody's born,
Yep.
right away they get it. There's a policy on them. So if you listen to the book that I mentioned here at the end, and I think on one or two of my promotional items, the book is called What Would the Rockefellers Do? That's a phenomenal book where they talk about all the aspects of their plan. And oh, it makes a lot of sense the way it's laid out. But so the question here from Shanta is, what if you don't have an extra 500 plus a month? This works with 2 to 300 a month? Question mark.
So it depends on your age because I have done this for somebody who's right off the college, started their first job. But understand this, you have to fund this to utilize it, right? So if you fund it $300 a month, and if you fund it probably 2,000, 3,000 a year, you're going to have that slow growth. So you're not going to be able to utilize it if you want to utilize it for investment purpose or education purpose. This is your vehicle where you're putting your emergency money away from it. Even if you have emergencies, a medical emergency, your job loss, if you have say 2,000, 5,000 sitting in here in couple of years, that's not going to be useful for you. So that's why I would highly encourage, that's a good starting point. At least start somewhere so that you can build on that as your age grows. If it works for a small amount when you're in your early 20s, but if you're in 40s and 50s and you start building that 2 to 3,000 per year, that is not going to be as beneficial for you. And remember, we are not buying just a life insurance. We are trying to exploit that dividend paying, so we want to overfund it.
Talk more about that because you can put more in there if they suddenly get like a good IRS return or something like that, right? Then they can do a big cash infusion, right? If it's in the first 7 years.
Yep. So I have another question here for Danny from Patrick. If you already have a whole life policy, can you build off current policy? So when I talked about the infant banking, and I talked about that these all words that I'm saying are very important, strategically structured whole life product dividend playing with mutual company. The strategically structured is really important. If you're building a house and you go to the architect and say that I want to build 3 bedrooms, 2 bathroom house, and now you have your wife is pregnant, and now you have another member coming in, and you say that okay, I have a plan. Now I want to add a bedroom to it. It's okay to have just 2 bathrooms. Can you do that? You cannot do that. So your current life insurance product, if it is not efficiently structured, we cannot utilize it because in a life insurance product, 100% of the cost goes towards building that death benefit. In the infinite banking, I slashed that cost to at least third and if possible even fourth. By the way, that slashes the commission structure also significantly. That's why only about 2%, top 2% agents implement infinite banking because the structure goes significantly down. But anyway, so that product that you have built is supposed to help you with the life insurance side of it. The example that I showed you that I actually did at what's called 1035 into the next structure, the infinite banking structure. So I took that out, I closed that policy, put it as a 1035 into the next policy, which was built as infinite banking, and that's what I utilize as. So yes, yes, you can use the your whole life, but you cannot use your current policy. But I can happily take a look at it and see if it is serving you. And we can keep that intact. We can build another one. As Jeannie was saying, that families like Rockefellers, Ford, Walmart, they build this multiple times. They at times have 20, 25 policies on different members. As soon as the baby is born, they build it up, start compounding. So by the time they're 18, college age or business age, they have millions of dollars sitting there and they have a discipline that now they can borrow from it, utilize it, replenish it, keep on doing that for the rest of their life. And that's how some part of inheritance is flowed through that structure. Of course, with estate planning and the trust, they did do another advanced strategies as well. Daniel has a question. If one way to borrow when paying back, will there be interest as well? What's the limit to pay the loan back? So I addressed the interest question, and please, Daniel, let me know if that's not addressed completely. But in terms of the paying back limit, when you have to pay the loan back, it's now really up to you. Remember, I was talking about the flexibility that when you can utilize it anytime. The paying back of a loan is also flexible. If you don't pay the loan back, in fact, or if you don't even pay the interest, it can eat away that cash value. So we don't want to compound the wrong side of interest. So I would always say that recommend to pay the simple interest. But if you never ever pay the loan back, what's going to happen is suppose you have that $2 million death benefit and you have $1 million outstanding loan, your heirs is going to take 2 million minus that 1 million outstanding loan. That's $1 million as an income tax free death benefit passed to the next generation. So hope that helps that. Perfect. I didn't understand the last comment.
Yeah, I'm not sure. Plasma electricity in the US?
Yeah, maybe that's not related, but yeah, I think
Maybe that's someone else.
yeah, yeah. Yeah, so I think take the advantage of I have a lot of education material. If even if you don't want to start looking at your structure, education is number one step, guys. Education. I cannot tell you how many people come to me and say that, hey, I started an IUL and it's not behaving the way it's supposed to do. It was 10 years back, and can you help me out? And I asked them one question about the policy, the structure, and they don't have any clue about it. Nobody has taken time to to educate them, to explain it to them where their hard and thousands of dollars are going. And that's my pet peeve. I come from a first generation immigrant. What that means is that every dollar in US was multiplied by 50. So even if buying a McDonald's dollar menu was expensive for me because it was 50 multiplied by 50. So everybody's hard-earned dollar, even a dollar, when I have rebuilt myself 3 times in this country, is really important for me. Tamika, please go ahead if you want to unmute and
Mavi, can I share my screen?
yeah, sure.
Yes, I was looking at the first profile you put up where it was I guess a lump sum of 100. You could start it with a lump sum of money. So even if we started with a lump sum, say 170,000, you still have to pay premiums every year. Is that correct?
So we can again have the flexibility, Tamika. Again, Ginny's policy is very peculiar. I wouldn't do that. I remember I was talking about one rule by IRS. There is a limit called MEC limit. Now I'm going in nitty-gritty details of it. But what
Mm-hmm.
limit is essentially in 1980s, Rich understood the power of this, and they would just put a ton of money, like create $1 million life insurance and put ton of money into it. So IRS
Mm-hmm.
said that, okay, your money, your cash values, it has to pass this MEG test. So it needs to have a certain amount of death benefit in a proportion of it. If that's not followed, then you lose your tax beneficial status. So any money that you take it out from it, it's going to have tax even if it's loan. So that's why that limit is really important. Overfunding first year, we have to be very careful about it. Ginny's structure, I had put a lot of effort to create that, but you can create a structure. Typically, the beneficial will be that consistently put it in for 7 to 10 years. And after that, you can choose not to pay for it. Now, Ginny can also choose not to pay for that $8,000 if she doesn't want to pay for after that 6, 7 years or so. When the dividend passes that minimum threshold, so when the dividend, her dividend becomes more than 8,000, she can actually stop paying into it. I can force that policy to stop paying into it, but I like the flexibility to be with you. You don't know what's going to happen in 10 years. You might actually have need to put more money into it. So I don't like to take it away, but the policy can self-sustain after a few years, and we can figure that out, what that mark is for you. But again, there's a flexibility on how you can fund, but a lot of consideration has to go through the structure. The structure is very complicated. I spent hours and hours creating that structure. The first model I will give you, that is just like a draft model. And then I'll try to understand from you that what is, I'll explain it to you first of all, that these are the 3, 4, 5 gears that we can change. Which gear do you want me to change? And as we go, we typically have 3, 4 meetings, and every meeting I will tweak that till you are satisfied about that model. We log that in and then submit that application to the insurance company. A lot of agents you will work, they will be like, here's your model. When can we submit an application? Because that's immediately converting that business. But for me, it's really important to tweak it, make it yours to your needs, make it suitable to that so that you can utilize it further.
Okay, thank you.
You're welcome. Ginny, you had something?
I was just trying to share this screen, especially because if anybody wants to book a call, then they can do that with me as well too, because mine's up there as well. Because again, this is the last meeting we're having until probably next year. If y'all want to reach out, this is the time to do that. And I want to respect your time. Any last questions?
And Ginny, I must say, what an incredible group. This is probably the longest I have stayed on the call. And you have an incredible, great amount of questions and deep questions too. You all have stayed for such a long time. So I'm really grateful and grateful to
Appreciate
Ginny
it.
as
Yes.
well.
And we'll send this out, if not tomorrow, the next day. I think, I'm not sure what else on the agenda for tomorrow. I know that there's a big conference again.
Ginny, you're not sharing your screen, by the way. You wanted to
I'm
share
not?
your no.
Oh, now it looks like I'm not to me. Oh, there are 3 more questions. I just didn't see them. Are you?
Yeah, I
mailing
think
this
somebody's
out?
just
Yes. So my part will be going out. Madhavi's, yours is not normally distributed. Is that what you said?
yeah, I don't send out the deck, but you can share the recording for sure.
Yeah,
And
so it's
yeah,
all
there's
got
more
all the same
material.
things.
Yeah, I do want to address Patrick has come in. IUL has to be set up correctly because if it wasn't, then it's never worked that way you intend to. The IUL is not meant to be infinite banking. It is sold a misconception at that, but IUL, in fact, if you're interested in showing that example, that is also one of my slide. I have about 150 plus slides. That's the reason I don't share it because every question I have a slide in there. So yeah, I'll be happy to show you what IUL does. IUL, real quickly, Ginny, IUL is supposed to be what's called renewable term every year. So the cost of insurance actually increasing. It starts low, but it's already all every year increases. So by 70, 75, a lot of people's IUL policies start lapsing. That means they don't hold true and they have to, their premium goes up significantly and they start getting these letters that, hey, pay this huge amount of premium, otherwise your policy is not going to be valid anymore. All the money that they have put in for the years and years to come. So that is what it is. It is not an IUL product. It is not tied to that. By definition of it, it's not an IUL. There is a lot of conversation, a lot of education material I have against it. Happy to share that with you, Patrick. I think this is just a spam.
Yeah, no worries.
Yeah.
Any last questions? Like I say, Madhavi is awesome. She'll be available to help you to explain more. And I'm here for anything else. And if you want to, I'd love to connect with you if I haven't already talked with you. Have you join our inner circle to know when we do have deals and that kind of thing. So I am going to go ahead and end the call so that you all can have the rest of your night together.